Hi, welcome to my channel. My name is Gil Rossi, investor and funds manager. Today I want to share with you my analysis of Apple. So let's get to it. As you may already know, I divide my valuations in qualitative and quantitative aspects. The qualitative includes past performance, management, competitive advantages, and financial position. Once I'm happy with all this, I go to the quantitative portion, which includes making projections and calculating intrinsic value and IRR. Okay, let's start with past performance. We can see in this graph the last 10 years of revenue. Here, the orange line that has been growing at a steadily 15.5% on compounding annual growth basis is revenue. We can also see the gross profit, the yellow line, which is the sales less cost of goods sold. If we subtract general and administrative to the gross profit, we get the operating profit, the green line. And if we add back depreciation and amortization, which is part of the cost of goods sold, we get EBITDA, the brown line. EBITDA is one of the metrics I use to arrive at the business value, and it has been growing over the past 10 years at a 14.8% on a compounding annual growth rate. Now let's see revenue by category, which they open in products and services. Products has been the main source of revenue, amounting for 80% of sales in 2020, but that is lower than the around 90% of sales in 2010. So services is becoming a source of revenue which is growing in importance, and I think it will keep growing share within the company's revenue in the future. The orange line is in the graph represents services. It's been growing faster than products in the last 10 years. And if I open products only, you see the iPhone is the predominant one, the green line here. And it has been growing in importance in the past decade. In 2010, it represented 44% of products, and in 2020, 62%. But since 2015, the proportion is declining. You can see how iPhone sales are relatively flat, while this line here, products, is growing. The main driver of this is the growth of wearables, because this is flat, and these other two, iPad and iPod and Mac, are also quite flat. Wearables, home, and accessories, this blue line here is the one that is making this grow, since the iPhone has sort of like stalled. So I think that this trend will be replicated in the future as the iPhone market matures. I think that most of the revenue in the future is going to come from products and from products other than the iPhone, and from services. In this table, we can see the figures that fed the graph that I just showed you. Sales of the iPad and the iPod have been roughly flat except in 2010, and the Mac has grown at a 5.1% compounding annual growth rate. The iPhone has grown at a very healthy rate, but you can see that it is mostly concentrated in the first half of the decade. Since 2015, it has remained pretty flat. While services and wearables have been growing substantially throughout the decade. Wearables at a 32% and services at a 21% compounded annual growth rate. In terms of unit sales, down here, until 2018, when Apple stopped providing this information, you can see a similar story. Especially, the iPhone has not been growing since 2015. The graph from AllConnect here shows the iPhone average price. As you can see, Apple has increased the average price lately as the growth of units sold has flattened. Another important aspect to keep in mind is the fact that people is taking more time to replace their phones. The graph from Statista shows the actual figures and the forecast up to 2024 from the US, and it shows a replacement cycle increasing to 3.77 years. All these are signs that let me think that the next decade will not be as dramatic growth for the iPhone as the past 10 years. Let's now check the cash flow for the past 10 years. Free cash flow, the orange line, has been growing at a 16.3% on a compounded annual growth rate. Capital expenditures has been between 3 and 6% of revenue, with an average of 4.55%. Free cash flow has been behaving quite consistently versus net income and versus EBITDA, which is a good sign, meaning there is no discrepancies between what we can see in the net income and the EBITDA and what we can see in free cash flow. And also it means that we can have a more reliable projections and therefore valuation of the business. The past 10 years of operating performance has been summarized here. Return on assets, return on equity, and return on investment have been very healthy. Return on investing capital, the measure I normally prefer of these three, has been very good, way above the cost of capital for the business, which I think it's roughly 8%, which means Apple has been creating value every year for the past 10 years. Margins are also quite healthy. Operating margin 26% on average for the past 5 years is a great number, although I would prefer to see it growing with the growth of sales and not flat or decreasing like has been the case, especially when services has been growing as a proportion of revenues, and we know that services has a better gross margin than products, as we can see here. This is the new information that Apple is sharing with us. It shows services having double the gross margin of products, which is roughly 30%. But gross margin is flat for the past 5 years at 38%, as you can see here. This makes me think that the new products, wearables and home, are a lower gross margin than the iPhone, because products gross margin is declining, as we can see here. But the decline is compensated by services, which is not only growing in proportion of sales, but growing gross margin as well. So the decline in operating margins can be explained by the increase in research and development and sales, general and administrative expenses as a percentage of sales. I generally see an increase in research and development as a good sign in an innovative company like Apple. But sales, general and administrative growing could mean that they have to spend more in advertising to sell their products. So that concludes my past performance analysis of Apple. As you can see, great numbers in growth, returns, operations. So I think that the company is very well positioned for the next 10 years and even for beyond. So let's now move to management. Let's start with capital allocation. One important measure of capital allocation skills, as you know, that I like to analyze is the return on investing capital that the company has been achieving. So as we can see in this table that I showed you before, return on investing capital has been very good, so I'm happy with this. And they have also been returning cash to shareholders, you can see in this graph, and in the form of buybacks and dividends. We can see in this graph that they have ramped up buybacks since 2017. I think this is attributable to the change in repatriation tax law, and Apple is now able to bring cash to the US and return back to shareholders. In the first part of the decade, up to 2017, they were accumulating cash without finding many places to invest it. Another good sign of good capital allocation skills, in my view, is the way that they have been handling acquisitions. They have been very frugal. They haven't been spending huge amounts of money in acquisitions like other companies do, especially when they have such a level of cash available to invest. This graph shows the money spent in acquisitions in the past 10 years. This one in July 2014 was the acquisition they made when they bought Beats Music and Beats Electronics for around $3 billion. Considering that has been accumulating cash reaching more than 100 billion, as we saw here, they were accumulating cash. And they have only spent 3 billion in acquisition in that period. Talks very highly of the capital allocation skills of management, in my view. they have for sure not fallen prey to the institutional imperative bias. This is my view of capital allocation. Let's now see management aligned with shareholders and compensation. In the proxy, they list compensation practices which are quite common in well-managed public companies nowadays. Especially, I want to note employment at will, no special benefits or pensions, no significant perquisites to executives, other than the security and private jet for the CEO. Compensation has the main components that are common in public companies: base salary, cash compensation, and two types of long-term equity awards: performance-based restricted stock units and time-based restricted stock units. These are structured based on total shareholder return relative to Standard & Poor's over the long-term period. I agree with the board that this is a straightforward approach. It is really as simple as it could get, and I believe is the right approach to align executives with shareholders. One thing I want to note regarding the CEO compensation. When Tim Cook became CEO in 2011, he was provided with a restricted stock award that had only a time-based vesting requirement. That is, the award vested 50% in 5 years and 50% in 10 years' time. No performance metric was required to be met. But in 2013, Mr. Cook, by his own initiative, requested the award to include performance metrics based on total return versus the Standard & Poor's, and only if Apple were to have better results than 2/3 of the companies in the Standard & Poor's, he would receive the award. So Mr. Cook's new measure had only downside risk, because only if he met this top third, he would get what he was awarded in 2011. And if Apple didn't meet this relative performance, he would be receiving less of his award. So I think that this is telling of what Tim Cook is as a person and as a manager, but most important, I think it shows the culture that he's imprinting into Apple. It's also of note that Tim Cook has not received any stock awards compensation since the one that he originally received in 2011 when he became CEO. Only now, in 2021, he will be awarded a new package, given that the old one has already vested completely by August 2021. And for a manager that has created $1.5 trillion along the way in the last 10 years since he started being CEO, and not requesting any change in or any additional, let's say, compensation or package in stock awards, really talks very well about him. And I think it's a person with all this that you can say that deserves the trust of shareholders. We can see here in this table the compensation of Tim Cook has been outdated in the past 10 years, really. If you compare it with what the rest of the executives are making, he is making much less, and which is not common in a company that the CEO makes less than the rest. But this is because he has what I've just mentioned. I am not saying that this is okay, but it talks very positively of Mr. Cook in my view. Also, we can see that compensation is quite reasonable for a company like Apple. And Mr. Cook, other compensation, which is security and aircraft here, is really, really very, very moderate. Let's now check stock ownership by insiders. We can see here Tim Cook and the other directors' ownership. Tim Cook owned roughly $420 million of Apple stock at the end of 2020, which I believe is a substantial amount and shows a great vote of confidence to the business. It's great to have the CEO investing such a large amount of his wealth into the company he or she manages. And the insiders as a group have around $1.2 billion of their own money into Apple stock, which I think is really, really a great sign. We can also see here Berkshire's ownership, which is substantial. And again, a good sign to have a vote of confidence from a person like Warren Buffett. In terms of dividend policy, I will show you again this graph where we can see how they are returning cash to shareholders in the form of dividends and buybacks. And dividends is the orange box here. I think the dividend policy is quite sound. They rely mostly on buybacks to return capital to shareholders, but still have a dividend which is small enough to allow them great flexibility in future capital allocation. So I am happy here. In terms of a long-term vision, I will let Mr. Cook explain Apple in this clip of January 2019.
Let me tell you the way I look at it.
Okay.
We manage the company for the long term. The most important things in Apple, one, a culture of innovation. This team is unbelievable in creating hardware and software and services and getting them all to work together. It just works. Second, we have a very large active install base. It hit 1.3 billion a year ago, and we've added about 100 million in the last 12 months. Third, highest customer satisfaction and loyalty in the industry. So you put those two things together, if you got a lot of a big active install base and you got a lot of happy customers, then you have a recurring revenue stream on your product business. And then because of our ecosystem that we built, which has unbelievable developers in it and an app store to get services out there, we built a services business that was a little over $7 billion in 2010. Last year, for the calendar year, over 41 billion. And we've said that, we're going to double the 2016 numbers by 2020. And so we're on a fast clip there. And then, of course, we are shareholder friendly on our capital allocation. So you put all these things together, and those are the most important things for us: innovation, customer satisfaction, and the overall size and loyalty of our customers.
As you can see in the clip, the three main drivers of value in Apple are innovation, customer base, and customer satisfaction. And all three are inherently long-term in nature. So that concludes management. So let's now go to competitive advantages. I think Apple has traits of three types of competitive advantages. In order of importance, I see intangible assets, switching costs, and network effects in part of their businesses. Intangible assets are provided by the technological edge they have, not only in software, but also in hardware. And the innovation within the company is going to surely keep this edge alive for the next 10 years and more. The other great thing that they have in intangible assets is the brand. And we all know the brand of Apple is very well known for quality in the way they manufacture their products, the way they make it work with the software and the whole ecosystem. And also it provides an aura of coolness to the one having an Apple product, and also makes you more attractive to the opposite sex. Which of course are great traits, and all this allows Apple to charge a premium price for their products, even though in terms of capabilities they may be similar than the competition. And switching costs is another great competitive advantage they have, based on hardware and software. So because if you want to change product, like go from an iPhone to another manufacturer, you'll have to not only to adapt to the use of the new phone, but also you will have to live and change the ecosystem. It's different than when you're using Android, that you can change manufacturer without leaving the ecosystem of Google, let's say. That's why I think the switching cost of Apple is one of the strongest that I've seen. And lastly, they have traits of network effect in their app store. As customers are attracted to the store to download apps, more developers are attracted to create products, which attracts more users in a virtual loop. I don't think this network effect is as valuable as those that you can find in companies like MasterCard or Visa or Amazon or Google even. In summary, I think Apple is a business with great competitive advantages, but they lack that great network effect, which I think is the strongest of the advantages for me. And so that advantage, the competitive advantages overall, are somehow vulnerable. To put it in the words of Warren Buffett, they have their castle surrounded by a moat, but the moat is not that deep and it's not as full of crocodiles as it should be. So summarizing, I am happy with their competitive advantages, and although I would not give them the highest mark, I still think that they have an undisputable pass in competitive advantages. And let's now move to financial position. Financial position is an aspect that will not require much analysis. If you check the balance sheet and the level of debt versus cash that they have, and if you compare that with free cash flow and EBITDA, there is no way Apple is running into financial trouble. It's a company that has been very well and very safely run in terms of its finances. In summary, Apple is a business that meets all the requirements of quality that I need and a potential investment to meet. Now let's see whether the relationship between price and value is acceptable to make an investment in Apple. Let me show you the way I am making my projections to reach future free cash flow and EBITDA, which are the metrics I use to value a company. So first, let me show you how I am projecting revenue. Using the segmentation that Apple uses, that is different products like iPhone, Mac, iPad, iPod no longer, but at the beginning of the past decade it was important, and wearables and home and accessories, which are products, and then services. This is the growth I am projecting for the next 10 years and the past 10 years for comparison. I am using the same reasoning that we discussed when we went through past performance. That is, services growing faster than products, and within products, Mac and iPad somewhat stalling, and the iPhone growing slowly, wearables growing quite fast. If you recall the interview of Cook with Jim Cramer, he mentioned that they had a goal of doubling 2016 revenue of services by 2020. And that was in January 2019. And today I can say that they met that goal 6 months in advance. Let me show you quickly that part again.
We built a services business that was a little over $7 billion in 2010. Last year, for the calendar year, over $41 billion. And we've said that, we're going to double the 2016 numbers by 2020. And so we're on a fast clip there.
I am being a little bit conservative in terms of growth for the next decade. And I think that's warranted in the case of products, because I don't think that they will be able to replicate in the next 10 years something similar to what they did with the iPhone in the past 10 years. On the other hand, in services, I think that they will keep growing fast. They have been growing at a 21% on a compounded annual growth rate. That means doubling every 4 years. I'm going to assume doubling every 6 years, which means 12% of growth. All these assumptions result in a total revenue growth of 7.3 on a compounded annual growth rate for the next decade. And this is a representation of the projections in a graphical form. Net sales, total, products and services. And here I have only products. So you can see the importance of the iPhone is diminishing, and the importance of wearables is increasing, while Mac and iPad keeps similar proportion. And here you can see that what I'm assuming is that proportion of services grows versus products, because this is growing faster. So let's now see the gross margin for each line of businesses, meaning products and services. And I project that for the next 10 years based on the behavior of the past 4 years, which is the information I have for this. Before they didn't open this information. So products decreasing gross margin, as you can see, and services increasing gross margin. So I will project similar performance. If you see from here, starting at similar levels, I will bring this down a little bit and bring this up a little bit. I then follow a similar approach to research and development and SG&A. I am assuming that both revert to levels that Apple experienced 3 or 4 years ago at 6 and 7, which is similar. And then I will assume that they go to levels that they experienced here, which are close to the average of the decade, 5 and 6. And with all this, I can get the operating margin. And you can see that my projections are the operating margin to stay practically flat with a little bit of growth at the end. Now I need to add back depreciation and amortization to operating profit to reach EBITDA. The way I project depreciation and amortization is based on my projection of capital expenditures that I'm showing here. If we see how the two variables have behaved in the past, capital expenditure to revenue and capital expenditure to depreciation and amortization. So for example, here we see, especially here, there's quite a big correlation. As capital expenditures to revenue grow, capital expenditures to depreciation also grow. What I'm doing is I am using this same correlation, and because I'm going to assume capital expenditures to revenue in the future at 4.5%, I think that it's going to be roughly capital expenditures to depreciation and amortization is going to be roughly at 1, which is here. So this way I can get EBITDA with the operating margin, as I showed you before, and then operating income. And if I add back depreciation and amortization, in this case I subtract because it's a negative number, to operating income, I get EBITDA. And this will be the projections of EBITDA for the next 10 years. And here we can see a graphical representation of the income statement for the past 10 years and the projections for the next 10 years. You can see that they follow, of course, a similar pattern because I am basing my projections on the past 10 years, so of course they will look roughly similar. Now let me explain my projections of free cash flow. I already showed you this table a minute ago when we discussed depreciation and amortization. You can see that I am assuming a growth for operating cash flow of 9% in 2021 and 6% 2030, and an interpolation for the years in between. The way I come with these growth assumptions is by keeping consistency with what I have assumed in the income statement. I want free cash flow to EBITDA and free cash flow to net income to behave in a similar way that they have done in the past. We can see here in this graph that they are behaving similarly to what they have behaved in the past. So I am happy with those projections. I already discussed the capital expenditures to revenue projection at 4.5%, which is roughly the average of the past few years. And with these two, I can get the free cash flow here, the projections of a free cash flow. Now let's get to the fair value using the free cash flow and the EBITDA projections I have made. I'm going to use an enterprise value to EBITDA ratio of 20, which is in line of what I would pay for companies like Apple, and enterprise value and free cash flow of 22, which means 6% free cash flow growth on a compounded annual growth rate for the next 10 years, meaning for after 2030. and then 3% in perpetuity after that, from 2040 onwards, with a weighted average cost of capital of 8.8%. So this is what I get. If I multiply the EBITDA on 2030 by the ratio, I get the enterprise value, and I subtract the debt, I get market cap. And I divide that by the weighted average stocks outstanding in 2030, I get the price, the target price of 2030. Same thing I do with free cash flow, and I get this price. And I average the two of them, and I get 258 as my target price for 2030. I will use this table to compute IRR here. I have the price paid, which is the price today, and the price I will presumably get 10 years from now, which is 258, which is the one I'm projecting. I also need to add the free cash flow per share adjusted for buybacks, which are already taken into consideration in my number of shares outstanding, and adjusted for stock compensation, which is not included in free cash flow. So this is free cash flow per share adjusted for those two measures. And the two of them give me a cash flow that I'm going to compute the IRR. So the IRR paying 127 will be 8.8%. I also make a sensitivity analysis here to compute different IRRs for different prices paid, and I'm looking to a price that would get me to a return closer to 10, which is the type of return I would be willing to get for an investment like Apple. If you see here, if you pay 115, which is 90% of today's price, you will be getting roughly 10% IRR. So in my view, this 115 would be the fair value of Apple. And that concludes my evaluation of Apple. So if you like the video, please give it a like, subscribe to the channel, and press the bell. And I'm going to upload another video in a couple of weeks. Probably it's going to be either Microsoft's or some other company. I'm not sure yet. So hope to see you then. Thanks for watching. Bye bye.